So last time we were discussing how as a company you can reconstruct yourself. And we were saying this: when a company has been making losses over a long period of time, it becomes difficult for that company to pay dividends and even to attract potential investors. We said no company or no investor would want to buy shares in a company that has been making losses every year. And of course, whenever a company makes losses, they can't pay the dividends to their shareholders. And so we were saying, if you are such a company, assuming you are a company A, which has been making losses over a long period of time, and therefore you can't pay dividends and you can't attract potential investors, what is the most logical thing for you to do as a company? We said the most logical thing for you to do as a company is to reconstruct yourself. And we went further and said the aim of reconstructing a company is to help that company to eliminate those accumulated losses in the books of accounts. We want to eliminate them from the books of accounts so that as a business, we start our activities from now onwards. In a more attractive and profitable manner. That's what we said. Then we went further and said, now that we know what is reconstruction, what is the purpose of reconstruction, we have said the purpose of reconstructing a company is to help that company to eliminate the accumulated losses. In other words, from now onwards, we don't want to reflect losses in our books again, and therefore we want to eliminate those losses and again start our activities from now onwards in a more attractive and profitable manner. Then we said, how do you go about reconstructing such a company? We said there are two approaches that a company can choose to reconstruct itself. One is what you are calling internal reconstruction, and the second approach of reconstructing yourself as a company is what you are calling external reconstruction. And we said, if you are reconstructing your company through internal reconstruction, we said all the stakeholders of the company will be called into a meeting so that they tell us what are they willing to sacrifice in order to help this company to eliminate those accumulated losses. What can you do as a group of stakeholders to help us to eliminate those accumulated losses? And we said one group of stakeholders may be ordinary shareholders, preference shareholders, debenture holders, and the creditors. And we were giving an illustration by saying it could be that as a company, we owe our ordinary shareholders 20 million of their capital. When we called them into a meeting, they were saying they were willing to write off 2 million shillings on their share capital. Maybe we called the preference, whom we owed them 30 million shillings of their capital, and maybe they were willing to write off 3 million shillings in order to help us. The debenture holders, maybe we owed them 40 million, and so they were willing to write off maybe 5 million. And so we were saying, in essence, when you look at that arrangement, it's like they're trying to reduce the finances of this company. In other words, we are reducing the capital of the company. So we said when it comes to internal reconstruction, the capital of the company is reduced. The capital of the company is reduced through what we called a capital reduction scheme. In other words, the stakeholders will come up with a scheme of reconstructing the company. They will come up with a scheme of reconstructing the company, and that scheme is what we were calling a capital reduction scheme. Good. That was what we said about internal reconstruction. The main thing there is to reduce the capital of the company. Then from there we discussed the second approach. No, we just mentioned the second approach of reconstructing a company, and we were saying if you decide to reconstruct yourself through the second approach called external reconstruction, then we say you as a company A, you will have to liquidate yourself. In other words, company A must be liquidated and they sell their business to another company, which you are assuming company B. This company B, we said, could either be another existing company, or it could be a newly formed company, So in external reconstruction, we said it occurs. External reconstruction occurs where a company is liquidated and they sell their business to another company. Or in other words, we said another company, calling it company B, which could be an existing company or a newly formed company, takes over the business. We said it takes over the business of the company that is being reorganized. That company that is being reorganized, they sell their business to company B, and therefore we said company A, we shall be referring to it as the selling company, while the company buying company A, which is company B, that company we said we call it the purchasing company. So I've just reminded you what we said through external. What's an external reconstruction? From there we now started discussing, I can see we started discussing the accounting entries for internal reconstruction. There are accounting entries for internal reconstruction. When you as a company decide to reconstruct yourself through internal reconstruction, what are the accounting entries? We went through about 6 official accounting entries. Let me mention them here. I don't have to go through those ones, so maybe I can just mention them here. We said if you are reconstructing yourself as a company through internal reconstruction, we said number 1 entry is with amount written off on share capital. With amount written off on share capital, whichever the share capital is, whether that share capital is ordinary share capital or preference share capital, whatever the amount is written off, we said you go reduce the share capital by debiting that share capital account, whichever the amount, we debit share capital, whatever the balance brought down here, and whatever the question is telling you to write off, we said you debit this share capital account, and we said you credit an account we were calling capital what? Capital reduction. You debit share capital, and we were saying you credit an account we were calling capital reduction. Don't forget, we were saying in this topic of internal reconstruction, the main account is this account we are calling capital reduction. We use it as an account to try and implement the scheme. So number 1 entry is with amount written off on share capital. Whatever the question will tell you, we debit that share capital account and we credit share capital reduction, whatever it is. And you come and say share capital, whatever it is. That was our entry number 1. Number 2, we said with amount written off on liabilities, be it the debentures, be it the creditors, if they are willing to sacrifice something, then you go to that liability account. We said with amount written off on liabilities, we know liabilities, we were saying, is a credit balance. Liabilities are always a credit balance. And so we said to write off any credit balance, you will debit that liability account and you will credit capital reduction. Whatever is the amount written off on liabilities, we said you debit the liability and you credit capital reduction. That was our entry number 2. Number 3, we said when the group of stakeholders met, they decided to help the company to eliminate the accumulated losses. Why can't we revalue some of the assets downwards? Why can't we revalue some of the assets downwards? And so we said with amount written off on assets, whichever assets, whether it's motor vehicle, whether it's furniture, whether it's building, and so on, whatever amount is written off on assets, we said if you go to that asset account, we know assets are always a debit balance. So whatever is the balance brought down here, whatever the question will tell you to write off, go and credit that asset account, and we said you debit this account we were calling capital reduction. Any amount written off on assets, we said you debit capital reduction and you credit the asset. That was our entry number 3. Let me remind you number 4. Number 4, we said with accumulated losses written off. With accumulated losses written off. Remember, I told you the purpose of reconstructing a company is to help the company to eliminate the accumulated losses. So whatever losses are appearing in the balance sheet, they must be eliminated from now onwards. So if you go to the P&L account of that company, we said losses are always a debit balance. Losses are always a debit balance. And therefore, to eliminate those accumulated losses or to write them off, we said you will credit that P&L account you credit that P&L account, and we said you debit this account we are calling capital reduction. You come and say here, P&L account, whatever the amount of the accumulated losses that you are writing it off. Good. That was our entry number 4. Whatever is the accumulated losses written off. We said you debit capital reduction, you credit P&L account. That was number 4. Number 5, we said, when you are reconstructing the company, don't forget we were assuming that you as a company, you as an accountant whom you have been appointed to reconstruct the company, we were assuming, suppose you are reconstructing this company as from 31st of December 2024. You remember that's what we were assuming. So we said you will ask for information of this company as at that date. Gather all the information that you can from the company as at 31st December 2024. Then we said, suppose in the process of gathering information, getting their balance sheet as at that date and all the other records, you realize that as at that date, this company had a contingent liability. This company had a contingent liability. I don't want to take you back and discuss what we said, what's a contingent liability, what's an example of a contingent liability. We discussed that in details, okay, in the previous lesson. But then, the most important thing I wanted you to remember when we were discussing this is that if as at the date you are reconstructing the company, you come across a contingent liability. Listen, I told you contingent liabilities don't appear in the books. They don't appear in the balance sheet. Contingent liabilities don't appear in the balance sheet. We said, but when you start reconstructing this company, as at from 31st of December, that contingent liability that the company has, we said it must be crystallized. In other words, make it as a liability in the books. We don't have it in the books. It is, yes, as a company, we have what we are calling a contingent liability. Remember, we were giving examples like court case, warranties, guarantees, and then we were giving the major example was what we were calling preference dividends in arrears. Listen, we said when a company has preference share capital and they are supposed to be paying, let's assume a 10% preference share capital worth 30 million. We were saying every year this company should be paying their preference shareholders a dividend of 10% of 30 million. That's about 3 million every year. But because the company has been making losses, then they were not paying the dividends. So, if this preference share is what we were calling the cumulative preference share, then the preference shareholders don't lose their dividend. So, if as a company, for example, you have not paid them for the last 3 years, every year you're supposed to pay preference shareholders 3 million. 3 million. For the last 3 years you have not paid them, then you as a company, you owe them 9 million shillings. That 9 million, we said, as at 31st December 2024, you as a company, you owe them that 9 million. But if you go to the balance sheet of the company, will you find a liability called preference dividends in arrears? If you go to the balance sheet of that company, as at 31st of December 2024, you will not find any preference dividends in arrears in the books. But as a company, we owe them. We said, normally, you as a company, you just keep knowing we did not pay the last year dividend, we did not pay the other year's dividend, and so on. But it doesn't appear in the books. Now that you are reconstructing the company, we say that liability should be crystallized in the books. Don't forget, we were defining a contingent liability as that liability which is likely to crystallize, in the future depending on the occurrence or non-occurrence of a future event. Depending on the occurrence or non-occurrence of a future event. I don't want to go back into the details of what we mentioned last time. But the key point was, once you realize your company has a contingent liability and you are reconstructing that company, that liability should be crystallized. In other words, make it as a liability. And I said, for most of your past paper questions, the examiner normally uses preference dividends that are in arrears as an example of a contingent liability. They use preference dividends in arrears. So what should be the entry? We said, with any preference dividends in arrears, or in other words, with any contingent liability arising, we said you debit capital reduction and you credit that contingent liability. That was our double entry. You debit capital reduction and you credit whichever contingent liability. I told you, if the question gives you the name of the contingent liability, like I'm specifically assuming it's preference dividends in arrears, then you credit this account called preference dividends in arrears. Preference dividends in arrears, if you know the name of the contingent liability. Otherwise, if you don't know, you just debit capital reduction and you credit contingent liability. That way you have crystallized that liability amount. You have crystallized that contingent liability. Then we went further and said, if the question tells you that this contingent liability was paid for immediately, then you will debit that contingent liability and you said you will credit bank or cash, whatever the case might be. That was our entry number 5, which said, with any contingent liability arising, you debit capital reduction and you credit that contingent liability. Good. Then finally we said number 6. That after you have implemented the scheme that the examiner will give you, after you have implemented the scheme that the examiner will give you, we said normally this account called capital reduction should be self-balancing. In most cases, it should be self-balancing. But there are times when you realize that after implementing the scheme, the account does not balance. So we said, if there is any balance remaining in this account, that balance, which in most cases it's always on the debit side, most times it could be on the debit side, then that balance we said should be considered as a capital reserve. We said that balance should be considered as a capital reserve. In other words, you take it to the capital reserve account. Normally it's a balancing figure. It's a figure you're not given. It is a balancing figure. If at all there is a balance in this account, then you consider it to be a capital reserve. Otherwise, some questions, you just realize that after you've implemented the scheme, then you realize that the account is self-balancing, which is okay. Good. Now, so those were the 6 official accounting entries. That is what we said. Number 1, with the amount written off on share capital. Number 2, with the amount written off on liabilities. Number 3, with the amount written off on assets. Number 4, with accumulated losses. Number 5, with any contingent liabilities. And finally, number 6, with any balance remaining in the capital reduction account. Listen, I also told you one key important point as far as the exams are concerned. Listen, I told you, most of your past paper questions, they will not remind you that entry number 4 to write off the accumulated losses. Most of your questions don't remind you to write off those losses. They will talk about how much write-off on share capital, which liability to be reduced, which assets to be reduced, and so on. Whether there is a contingent liability like preference dividends in arrears, it could be there. But most questions, in the additional information somewhere, they don't remind you to write off the accumulated losses. But I do hope you remember we said, whether the examiner reminds you or he does not remind you, it is your responsibility to know, why are we reconstructing this company? We are reconstructing this company so that we help them to eliminate the accumulated losses. So I told you last time that even if the examiner does not remind you to write off the losses, it is your responsibility as a student to remember that you have to write off the losses. After you've implemented the scheme the examiner will give you, and the examiner has not reminded you to write off the accumulated losses, before you close the books of accounts, remember to write off the accumulated losses. It will be there in the balance sheet. Why? Because that's why we are reconstructing the company. This company has been making losses. So go to the balance sheet of the company, find out how much are their retained losses, write it off. Okay? Good. Now, before we do a question, I just want to remind you two key important points that we mentioned before we do the question, because we are almost now there to do a question. I told you, as we were entering these transactions, I told you and I asked you a few questions and you gave me the pattern that you noticed. I told you, for example, very fast, just to remind you very fast, we said, with amount written off on share capital, if you are writing off 2 million shillings, and I remember we were using 2 million, I think so. Let me see. Yes, here, yesterday, no, the other day, we were writing off 2 million. And we were asking ourselves, when the shareholders are willing to write off 2 million of their capital, to us as a company, is it a gain or is it a loss? When the shareholders are willing to write off 2 million shillings from their share capital, we had to debit share capital, we had to credit this account called capital reduction by how much? 2 million. And we concluded, to us as a company, that is a gain. That is a gain. Don't forget, we are not looking at it from the point of view of the shareholders. To them it's a loss. But to us as a company, their share capital was 20 million. They are willing to write off 2 million to help the company to reconstruct itself. Therefore, as a company, we are gaining. Why are we gaining? Because we are reducing what we owe to the ordinary shareholders or to the shareholders. When they are willing to write off 2 million, then as a company, we are reducing what we owe to them. Therefore, we said that is a gain. Number 2 entry, I told you, with amount written off on liabilities, maybe the debenture holders, we owed them 40 million initially, but when we asked them what they can do for us, they said they are willing to write off maybe 1 million or 2 million, whatever the question will tell you. And so with amount written off on liabilities, we had to debit that liability account and we had to credit this capital reduction. And therefore, again, I asked you, to the company, is it a gain or is it a loss? And I saw, or we concluded and saw, that when you as a company, you are reducing what you owe to the debenture holders, then to you as a company, that is a gain. When we were asking them, what can they do for us, you debenture holders, what can you do for us so that you help us to reconstruct the company? And they were saying they were willing to write off 2 million of their liability. So as a company, we had to debit the liability account by 2 million and credit capital reduction by whatever the amount. That is a gain to us. Why is it a gain? Because we said you as a company, you are reducing what you owe to the shareholders, what you owe to the shareholders. Good. Then we also said, number 3, with amount written off on assets, we had to credit assets and to debit capital reduction here. But then I asked you, to the company, is it a gain or a loss? And we saw that when you as a company, you are writing off some of your assets, as a company, you are reducing some of your assets, then automatically that became a loss to the company. That became a loss to the company. Then I also told you, with any contingent liabilities arising, we said you have to crystallize that liability. How did you crystallize that liability? By debiting capital reduction there and crediting this contingent liability. Could be preference dividends that are in arrears. And then we asked ourselves, to the company, is it a gain or is it a loss? And we concluded last time that that is a loss to the company. Reason being, listen, before we started reconstructing on 31st December 2024, we owed the preference shareholders 9 million. That's very true. But that amount of 9 million was not appearing in the books before. It was not in the books of accounts before. We just knew as a company, we owe the preference shareholders 9 million for the last 3 years. But when we are reconstructing the company, we said that liability should be crystallized. And so from now onwards, your liability of 9 million, you will show it in the books. So we concluded that because before reconstruction it was not there, then after reconstruction it must be there in the books. Then it is obvious as a company, our liabilities are increasing. Our liabilities are increasing. And when liabilities are increasing, then that is a loss to you as a company. Good. So we saw that as a company, whenever there is a contingent liability and it has to be crystallized, that is a loss. And so we saw a pattern. I hope you now can remember. We saw a pattern and said, it looks like, we saw this pattern, it looks like every time the company was reconstructing themselves and they were making a gain, that gain was automatically being credited in the capital reduction. That gain was automatically being credited in the capital reduction. And it also seemed that every time the company was being reconstructed and the company was making losses, that loss seems to be debited in the capital reduction. And the reason why we had to look at this is because, listen, now the point was, why are we having to analyze these transactions? We said, there are times when the examiner might give you a question and in the additional information, maybe number 10, additional information number 5 or whatever, there is a transaction the examiner has given you in that question, which is not among the 6 official entries that we have discussed. And so we say, the moment you realize that by implementing that transaction, by implementing it, the company will make a gain, then automatically we said that gain should be credited in the capital reduction. And then we said, in case you realize that by implementing that transaction, this company will suffer loss, that loss, we said, should be debited in the capital reduction. So the reason why we were analyzing this transaction is because there are times when the examiner may give you other transactions which are not among the 6 official entries for internal reconstruction. But whatever way, so long as you realize that this company will recognize a gain or will make a gain in the process of implementing that transaction should be credited in the capital reduction. I gave you an example and we said, suppose one question tells you share premium to be written off, and we said share premium is an amount that belongs to shareholders. So if the group of stakeholders decided they are going to write off share premium being a credit balance, we said if it's to be written off, you will debit share premium and you credit capital reduction. As a company, we are gaining. Why? Because we are reducing what we owe to the ordinary shareholders. Share premium is part of equity. And therefore, if the company decides we are writing off the share premium, then to us as a company, we are gaining. Why? Because we are reducing what we owe to the ordinary shareholders. I said the question could tell you general reserve, the question could tell you general reserve to be written off, or maybe revaluation reserve to be written off. So long as it's part of equity and it's something that belongs to shareholders, then automatically as a company we are going to gain. Then I also gave you another example. Suppose the question tells you under note number 7 or 8 that in the process of reconstructing themselves, the company, in the process of reconstructing this company, we had to incur shillings 2 million as a reconstruction cost. We had to spend 2 million to reconstruct ourselves as a company. Of course, we said that transaction is not among the 6 that we have discussed so far. But then, in the process of reconstructing ourselves and we are spending 2 million, as a company, are we gaining or losing? It's obvious we are losing. Then we said that loss should be debited in the capital reduction. So with any reconstruction cost incurred, you will debit capital reduction, and we said you will credit bank because you are spending some 2 million to reconstruct yourself. So So you will debit capital reduction and credit bank or cash, whatever the case might be. I think I've taken you through in an overview what we discussed in the previous class, and we had to write the summary notes. I can see it here. We must have written the summary notes. Good. These are the accounting entries we wrote last time. Those are the accounting entries in form of the journal entries. Good. I think now I've reminded you what we discussed in the previous class, so we can now project a question to be done. I want to project a question to be done. Now listen. The question I want us to do is a question that came in November 2016. Listen. That question, if I can remember clearly, has been duplicated 2 or 3 times in the later years. It is a question that came in 2016, but the examiner has almost duplicated it, only changing the figures and the name of the company. Otherwise, the wordings are almost the same. So we are doing a question which has been repeated almost several times. Word by word, it's only the change of figures and maybe the change of the name of the company. So let me project the question. So that we can now do that question now. Hoping that now you can remember what we have said or we said last time. And now good. I've projected it there. I don't know whether you can see it. If you can see it clearly, chat yes. If you can see it clearly, you chat yes. Yes, good. Sawa. So let's continue. It is a question that came in November 2016. Question number 3. Number A says, explain 4 differences between internal reconstruction and external. That one you can do later when we discuss the external in details. But my concern for today is part B of the question. That's the one I want to read. It says, the following is a summarized financial statement of P Limited as at 30th of June 2016. In that balance sheet, you are given non-current assets. Among the non-current assets, you have tangible, which is freehold property, plant. Then you have intangible in the name of patent, goodwill. Then you have among the current assets there, you have inventory, accounts receivable, and investment. You are given in bracket market value to 24 million. Then I roll the question. Again, you now go to current liabilities, among them trade payables, bank overdraft, debenture interest payable, accruals, directors loans. That's all about current liabilities. Then we go to the section called financed by. Among that is share capital, 120 million ordinary shares of 10 each, 6%, 64 million cumulative preference shares of 10 each. Good. Now next we have revaluation, revenue reserves. Among them we have accumulated losses. Remember, the reason we are reconstructing the company is because they have been making these losses. Good. Finally, the section called non-current liabilities, we have a 6% debenture. Then we are told by the additional information, let me roll it there. The additional information number 1 says, the 6% debentures holders were to have the 6% debenture holders. Let me start with the note kwanza. The court approved a scheme of reorganization submitted by debenture holders and agreed upon by interested parties to take effect on 1st July 2016. Details of the approved scheme are as follows. Number 1, the 6% debenture holders were to have their interest paid in cash and to take over part of freehold property, book value 160 million at a valuation of 192 million in part repayment of their holding. The 6% debenture holders are also to provide additional cash of 208 million secured by a floating charge on the company's assets at an interest rate of 12% per annum. Number 2, patents and goodwill are to be written off. Shillings 120 million is to be written off of inventory, and that 93.6 million is to be provided for bad debts. The remaining freehold property is to be revalued at 620 million. The investment was sold at the prevailing market price. Number 3, the directors were to accept settlement of their loans as to 90% thereof by allotment of ordinary shares at par and as to 5% in cash. The balance of the 5% was to be waived. Number 4, trade payables are to be paid shillings 0.1 in every shilling to maintain and obtain an extension of the credit period. Number 5, the bank has sanctioned an overdraft limit of shillings 10 million to provide working capital. Number 6, the 6% preference dividend are 4 years in arrears, of which 3/4 are to be waived and ordinary shares are to be allotted at par for the balance. Number 7, the 6% preference shares are to be written down to 7.5 each, and existing ordinary shares to 2 shillings each. All ordinary shares are to be consolidated into shares of 10 each. The rate of dividend on preference is to be increased to 10%. Number 8, there are capital commitments amounting to 600 million which are to be cancelled on a payment of 3.3% of the contract price as a penalty. Then you are required, number A, you are required to prepare a capital reduction account to record the scheme of capital reorganization. Number 2, prepare a statement of financial position as at the close of business on 1st July 2016, immediately after effecting the scheme of reconstruction or reorganization. Good. Now, so let's go back now and discuss one item after the other and look at how to implement it. Let me go back. Number 1. I hope you are there. Number 1. Number 1 says the 6% debenture holders were to have their interest paid in cash and to take over part of the freehold property, book value 160 million at a valuation of 192 million in part repayment of their holding. The 6% debenture holders are to provide additional cash of 208 million secured by a floating charge and the company's assets at an interest rate of 12% per annum. There are several things there. So the first part says the 6% debenture holders are to have their interest paid in cash. We agreed. Fine. If you look at the balance sheet up there, among the current liabilities up here, we have debenture interest payable amounting to how much? 36 million. When we called the debenture holders, we agreed that one thing we should do is to have the 6% debenture holders were to have their interest paid in cash. Their interest paid in cash. So let's pay them that interest. If you look at the balance sheet, we have seen According to the trial balance sheet, among the current liabilities, there is an interest payable of 36 million. Let me confirm the figures are in millions. Yes, 36 million. So we owe them 36 million. When we called a meeting, we agreed that it should be paid in cash. Good. So let us just debit the liability. We are just paying it. Just debit liability and credit bank. Good. So let's do the question now. This is November 2016. Question 3. We are paying the interest of 36 million in cash. So we just debit the liability and we credit bank. So just open an account called bank account. Open a bank account. Make it a bit longer because it seems there are other transactions that need this bank account. Make it about 7 or 8 lines there for the bank account. So open this bank account. Go to the balance sheet, bring down the original bank balance. Bring down the original bank balance. So let's go to the balance sheet for the company and find out according to the balance sheet. If you look at that balance sheet, among the current assets, there are no bank accounts, not even cash. But when we look at the current liabilities, among them, we have an overdraft, bank overdraft of 312 million. Good. So let's bring down the liability called bank overdraft. Balance brought down 312. But we want to pay the debenture interest. We want to pay the debenture interest. So let us debit debenture interest account and we credit bank. So come and just see here, debenture interest. The amount was 36. I don't have to open the account called debenture interest because it's just one entry and we are writing it off. So I don't have to open the account called debenture interest. We have it in the balance sheet as a liability. Yes, it's a credit balance. So to pay it, we just debit creditors. We debit interest payable, we credit bank. But because I don't need the account called debenture interest again, I don't think I've read anywhere else where it's being affected. That one we can leave it there. So I'm through with part 1, one part of number 1. I'm through with one of the items in note 1. So let's go back to note number 1 and continue with the rest of the items now. And continue with the rest of the items. So what is it saying? Having paid debenture holders their interest in cash. Of course, when they say cash and bank, it's the same. Doesn't matter. Then from there, it says, and that's where I'm picking from, and to take over. And to take over, that's where we are now, and to take over freehold property. Book value 160 million at a valuation of 192 million in part repayment of their holding. Who are these that are to take over? Don't forget the question note 1 started by saying the 6% debenture holders to have their interest paid in cash and to take over. Who therefore? It is obvious the 6% debenture holders. When you look at the balance sheet up there, we owe them how much? 600 million in the balance sheet. That is the non-current liability. But the question says, and they will take over, the debenture holders, they will take over part of the freehold property whose book value is 160 million at a valuation of 192 million in part of repayment of their holding. Good. So we want to pay part of that 600 million by giving what? By giving a freehold property whose value in the books is at 160, but we are giving it out at a valuation of 192. Good. So let's open an account called debentures. 6% debenture. It's what we want to pay, but we are giving out the freehold property. So make it about 4 lines there or 3 for debentures. Then you open another account called freehold property. Freehold property. So let's bring down the balances first. Let's bring down the balances first. Debentures a liability. We come and see a balance brought down. I've already seen it in the balance sheet. We have agreed it was 600 million. Let me confirm from the balance sheet. Yes. Then I also go and pick the value of the property. Balance brought down. If you look at the balance sheet up there, the freehold property there was what? 680 million. 680 million. Bring it down. So we come and see a balance brought down. 680 million. Now, listen. The question says, and to take over freehold property, book value 160 at a valuation of 192. So what do you think? Which account do you debit? Which account do you credit, and by how much? We called in the debenture holders. They gave us this condition, that they are willing to help us. First, if we pay them their interest in cash, which we have already done, we also agreed with them, they can take part of the freehold property, whose book value is 160. They can take it over at a valuation of 192 million in part of the repayment of the holding. So, which account will I debit? Which account will I credit? And by how much? And by how much? Listen, I want to guide you. Don't forget, don't write this. That asset is here in the 680. It is there at 160. Don't write that one. But we wanted to leave the books of accounts at how much? At 192. We agreed them to take over property, book value 160 at a valuation of 192. So I think you are getting my point now. So what do? We debit which account and credit which account, and by how much? We debit which account and credit which account, and by how much? Yes. We want the asset to leave the books at 192. But it appears in the books at 160. So what is it that the examiner wanted you to do first? I've given you a hint. I've even given you a hint. Revaluation. Correct, Gilbert. That's correct. Now listen. So if it is worth 160 in the books, but we wanted to leave the company at a valuation of 192, then the examiner wanted you, before you release the asset, you as a company revalue it in your books. Make it to come or to become a 192 asset in your books. So the examiner wanted you to revalue the asset first by an extra how much? From 160 to 192, it means we are revaluing the asset by an extra 32. So we increase the value of that component from 160 to 192. Once we increase it by 32, then it means that it will be in the books now at the correct value, 192. Therefore, we can use it to do whatever we want, which is what they are saying. Use it to pay the creditors, so debentures. Use it to pay the debentures. So the trick here was the examiner wanted you to first revalue the asset. First revalue the asset. Okay? And we are revaluing it upwards from 160 to 192. Don't forget, listen. Listen carefully. We are not running a normal business. We are reconstructing this company. If we were running a normal business, then I would have debited the property account by 32 million and credited an account called revaluation reserve in a normal business. But now we are not running a normal business. We are reconstructing this company. And I told you, any gain that the company makes in the process of reconstructing themselves, that gain, I told you, should be credited in the capital reduction. Are you there? Good. So the other point is, you don't revalue like we are revaluing a normal business asset. No. Because we are reconstructing the company, and I told you our operating account becomes the capital reduction. So let us debit this account called freehold property, and we come and credit capital reduction by 32 million. I have debited asset to make it 192. I've debited asset. Maybe if you think you'll forget, somewhere you can put in bracket revalue, so that you just remember we are revaluing, that we are gaining 32 million because of revaluation. Okay, so let us debit the asset, which I've already done, and now we can credit capital reduction. So let's go to where we opened. We don't have it. Good. So let's open an account called capital reduction now. Let's open an account called capital reduction. It's another major account, so make it a bit longer. Make it about 10 lines. It's a major account. We have to debit freehold property and we credit capital reduction. So let me come and say a freehold property by 32. Good. Of course, if the examiner was asking you to do the journals, you would have debited property by 32, you would have credited capital reduction by 32, and then you would have said being the gain on revaluation. Being the gain on revaluation. If it was journals, but now it's ledgers. Okay. Now finish. I want to go back to the account called property. We have revalued the asset. But remember, that's not the aim of reconstruction. The aim of this company is to give it out. To who? To the 6% debenture holders as part of the repayment of their holding. Good. So let's go back now to the account called property. Now that it's in the books at 192. What have they told us to use it for? To repay part of the 6% debenture holders they are holding. So let us just credit the asset. We credit the asset here called freehold property, and we come and say a 6% debentures by 192. By 192. We are crediting freehold property by 192, and we debit the 6%. We had already opened that account, so just come and say your property 192. Good. So I've implemented the second part of note 1, and I think it still had something else. Let's go back and see what it is there. But the tricky item there was the revaluation. That you don't remove it in the books, from the book, at 160. You have to remove it at a valuation of 192. So the trick the examiner wanted you to note there is that we are revaluing the asset first. From 160 to 192, we debit the asset by 32, and we credit revaluation. We credit capital reduction. Otherwise, I've said it's not a normal business we are running. We are reconstructing. This being a gain on revaluation, you debit the asset and you credit capital reduction. Then I've told you, once you do that, it will appear in your books at the correct value now. Use it for whatever reason. The question has told us, we use it to repay the loan or to repay the debentures. So I credit the asset and I debit the debenture account. Good. So let me take back to the first note again. See what they wanted more, if there is anything else to be done. Yes, we are still not through yet. So let's go back and read note number 1. We are still going back to note number 1. We are through with the second line of note 1, where the question said, and to take over freehold property, book value 160 at a valuation of 192 in part of the repayment of their holding. That we are through. But the question goes on to say, the company, the 6% debenture holders are also to provide the 6% debenture holders are also to provide additional cash of 208 million secured by a floating charge on the company's assets at an interest rate of 12% per annum. Now listen, let me explain it. Remember, we are reconstructing the company. So we asked the stakeholders, what else can we do? And as a group, we agreed, we need finances. Why can't we request these debenture holders to provide additional cash of 208 million, and we shall secure these debentures or this liability on a floating charge on the company's assets at an interest rate of 12%. So we asked the debenture holders, please give us some additional cash. We need cash as a company. They asked us, how much do you need? We said 128 million. How are you going to secure it? On a floating charge. What rate are you going to pay us? At 12%. Listen. So it is obvious, listen, it is obvious, like as a company, it's like the debenture holders are giving us a loan at 12%, which is secured on a floating charge. Or we can even say, it's like we are issuing, listen, we can even say it's like we are issuing another debenture to the debenture holders. Remember, the original one was at 6%. Now we are raising more funds, but at 12%. Okay? So it's like we are issuing another debenture worth 12%, whose interest is 12% to the debenture holders, but this new debenture will be secured on a floating charge. It could be the other one was secured on a fixed charge, but this one now is secured on a floating charge, whatever the case might be. But that's not the concern. The concern is, listen, that we are asking for additional capital as a company. Who are we asking them to give us? The existing debenture holders. We are asking them to give us money. We shall repay them at 12%. Okay? Now listen. So the question does not tell us whether you treat it as a loan or you treat it as another debenture. But whether as a loan or as a debenture, it is carrying an interest rate of 12%. So you cannot combine it with the original debenture of 6%. Those are two debentures or two liabilities. The original one is a liability of 600. We have paid part of it, but now we are asking them to provide additional cash of 208 million to be secured on a floating charge with an interest of 12%. So I've said, here the examiner gave you the freedom to treat that 208 million either as a loan or you can treat it as another debenture being issued. But the point is, whether loan or debenture, it is at 12%. So you can't combine with the original debenture. Good. So now that we are receiving more cash, listen, it is obvious we shall debit bank account. We are raising more cash to 8 million. But then I'm saying, whether you will credit the loan account by 208 or you will credit another account called 12% debenture, the examiner will not penalize you so long as you treat it as a liability, which is obvious. Okay? So there is another liability coming up, or we are raising another liability as a company worth 208 million, and that liability will carry an interest rate of 12%. So whether you requested the debenture holders, can we issue to you another debenture worth 12%? Or is it a loan? That is freedom. You have the right to choose. The question there was not specific, but you can still treat it as another debenture you are issuing to them, but 12% debenture. Or you can treat it as a loan raised from them at 12% loan, whichever way. But either way, you must debit bank because you are receiving, and you must credit the liability. So let's go to the debit account of the bank account. Let's go to the bank account, which we had already opened, and you debit, and you say yeah, 12%. Let's call it debenture. Let's just call it debenture, amounting to 12% debentures, amounting to 208 million. 208 million. Good. Now listen, I don't need to open the account called 12% debenture because I don't think I've read anywhere else where that account is being affected. I have not read any other additional information where it's being affected. So we don't need to open it, because even if we open it, it will be just a one-line transaction. So, but you will remind me when we are doing the balance sheet that we have a liability of 208 million in form of debenture. Good. So I think I'm through with note number 1. We can now move on to the next note. We can now move on to the next note. I think we can now move on to the next note if you are through with the copying. Let me project note number 2. Number 2 says, because we are through with number 1, patents and goodwill are to be written off. Then it also goes on to say the 120 million of to be written off on inventory, 93.6 million to be provided for bad debts, the remaining freehold property again to be revalued at 620 million, and investments to be sold at the prevailing market price. There's a lot there, so let's go one by one. It says patents and goodwill are to be written off. Good. So let us write off those two assets. Go back to the balance sheet. What's the value of the patent? I can see there among the intangible assets, patent is worth 244, while goodwill is worth 224. Of course, we have just said a short while ago, with the amount written off on assets, you debit capital reduction and you credit the asset. So let's go to the capital reduction account and we debit it. And we come and say a patent. And the other one was goodwill. We are writing them off. I don't need to open the account called patent. I don't need to open the account called goodwill because we are just writing it off. Good. So patent is 244 while goodwill is 224. Good. So we are through with that part of note 2. We are through with that part of note 2, which says patent and goodwill to be written off. Let's move on to the next item. I think they said something to do with the inventory. Let me project the note. Yes, note 2 says patent and goodwill to be written off. Then it goes on to say shillings 120 million to be written off on inventory. Good. That is simple. We are writing inventory by 120 million. So let us just debit capital reduction and credit inventory. We are writing off another asset by 120 million. We just credit the asset. I don't need to open the asset account because it's all just a one-time transaction. Just a one-time transaction. There was no other transaction affecting inventory. So we shall just reduce the asset called stocks by 120 million. So I'm crediting the asset and debiting capital reduction. Good. So that is it. I move on. We are still under note number 2. It goes on to say what? Note 2, after inventory, they are saying and 93.6 million to be provided for bad debts. to be provided for bad debts. In other words, reduce our debtors by 93.6 million. Good. Just reduce our debtors by 96.3 million. So that means we credit debtors and we debit bad debts. Good. So just come and see your debtors. 93.6 million. I don't need to open bad debtors account. Whether they are calling it trade receivables or debtors, that's okay. No problem. We are debiting capital reduction and crediting debtors. Okay. Good. Let's go to the next item. Let's go to the next item. I think the next note under that, or still under number 2, sorry. Still under number 2, it goes on to say, to provide for bad debts. Good. The remaining freehold property to be revalued at, the remaining freehold property to be revalued at 620 million. Good. So do for me that calculation. Find out for me whether there is a gain or loss on revaluation. Go to your freehold property. Wamesema the remaining freehold property to be revalued to 620 million. So do that calculation and tell me whether it's a gain or loss on revaluation and by how much. If somebody do that calculation and you chart the remaining freehold property to be revalued at 620 million. I want to see. So do that calculation and tell me whether it's a gain or loss on revaluation. I just want to see from your end. So calculate and say whether it's a gain or loss on revaluation. Wamesema the remaining freehold property to be revalued at 620 million. So look at the revaluation at the property account that you have done. Then tell me whether it's a gain or loss on revaluation. Go to your revaluation to the property account that we have just prepared. Wamesema the remaining property is to be revalued at 620 million. So is there a gain or loss on revaluation? And if so, by how much? Hey, I'm waiting. You have already prepared a property account. Yes. Gain or loss? And by how much? Yes. Oh my, we are waiting. Loss of 60, loss of 60. What? Let me roll the. Somebody has said a loss of 60, loss. Loss. 60. Okay. So let's see. Now listen. That's the reason I've not shown the account on the screen. Listen. I am hoping. Listen. I am hoping you have not gone to the balance sheet and compared the book value that you were given there, 680, in the balance sheet with the 620. I am hoping That's why I did not project. 68 gain. I don't know, but I'm saying let us now look at it together. It's a gain of how much, Jimmy? Is it Jeremy or Jamie? Loss of 100. Wow. What are you saying? Listen. Do not forget. Do not forget. We had to revalue one property from 160 to 192. Listen, at the same time, we had to use it to repay part of the debenture. Then the examiner now says, after we have done that, the remaining property to be revalued at 620. So what I'm hoping, because most people are giving me 60, I'm hoping you have not gone to the balance sheet, check the book value that was there, 680, compared with the book value of evaluation of 620, and you saw it a loss. No. Don't forget, there is a transaction that has just taken place just before we decided to revalue the remaining. What was that transaction? It's true we began with 680. We revalued one of the property that was in the books at 160. We had to make it 192. When we made it 192 by revaluing it by an extra 32, we gave it out as part of the repayment of the loan. No, of the 6% debenture. That's why we credited the asset called property, and we debited the 6% debenture. So we no longer have assets worth 680. You have to get the remaining. Let me confirm the remaining, which means it's like you are balancing the account called property first. I hope you are getting. Let me see some of you who got it, whether you got it or wrong. Now, let me get 680. I'm doing the calculation. 680 plus 32 minus how much? 192 on the credit. So we are remaining with 520. That 520 is the amount remaining of the freehold. Then they are saying it should be revalued to 620. So it is obvious there is a gain on revaluation amounting to 100. So we debit the asset with that 100. Don't forget, listen, I told you we are not doing a normal running of the business. Otherwise, I would have debited the asset, I would have credited revaluation reserve. But I told you we are not running a normal business, we are reconstructing. I told you any gain you make in the process of reconstruction should be credited in the capital reduction. I also told you any loss made in the reconstruction process should be debited in the capital reduction. So ours being a gain, you come and say here, gain of 100. So you come and say a capital reduction. So let us debit freehold property and we credit capital reduction by that 100. So let's go to the capital reduction and we come and credit it. Where did we open it? It's here. So you come and say again freehold property. We have it here 100. So yes, some people got it. They were giving me a gain of 100. Good. So that is it for that note. So let's go back and check whether there is any other note, number 2, to be done. We have implemented that revaluation. They said the remaining. So the trick was you don't compare the book value of the property. Remember, we had already revalued part of it and used it to pay the loan of the debentures. Good. Let me project note number 2. We see whether there is anything else to be done. Oh yes, there is something else to be done there under note number 2. it says the last sentence, the investment was sold at the prevailing market price. The investment was sold at the prevailing market price. When you look at that investment in the balance sheet, originally, according to the balance sheet, investments among the current assets had a book value of 88. You see that book value? 88. We are told it was sold at the prevailing market price, and the prevailing market price is 214, 224. So let's sell it and make a gain. It looks like a gain on sale. Good. So let's open an account called investment. It's simple. That is not hard. That is not hard. So open an account called investment. We want to sell it and make a gain. We don't just want to keep it. We come and say here investment. Bring down the balance, make it about 3 lines. It's 88. That was the book value, 88. We are told it was sold at its prevailing market price. 220 what? I think 224, let me confirm. Yes, 224. So let us debit bank because we are selling. We debit bank and we credit this account called investment. So let's do it. We debit bank. That is 224. And let us credit this account called investment. I've already debited bank. Now I credit this account called investment and I come and say your bank. 224. But don't forget, we can't leave the account pending. We have already sold this investment. So there must be a gain or loss on sale. According to this case, it's a gain. Listen. We are not running a normal business. We are reconstructing this company. And I told you, anytime you are reconstructing a company and the company makes a gain, that gain, for whatever reason, it should be taken to the capital reduction. So let us close the account by debiting investment and crediting capital reduction by a difference of how much? We made a gain of how much? Let me calculate. We sold the investment for 224 when the book value was 88. So we made a gain of 136. So I'm debiting investment by 136 and we credit capital reduction. So let's go and credit capital reduction. Just sell on investment. Where is it? Here. Come and see here, investment. 136. Good. What account did you credit with the provision for bad debts? The debtors. Catherine, you debited capital reduction here. When the examiner told us and to provide for bad debts, of 93.6 million, bad debts come because of debtors, mark you, or what you can call trade receivables. So here, look at this. I debited capital reduction by that 93.6. I had to credit debtors account. But, listen, but I said I don't need to open debtors account because it is just recorded once. So when we shall be doing the balance sheet, you will remind me that our debtors account is reduced by 93. Are you okay? There is that person who has asked the question, Catherine, that we are debiting capital reduction and crediting debtors, or you can call it trade receivables. No problem. Are you okay, Catherine? And because I said we did not read any other additional information affecting debtors or accounts receivable, that's why I did not need to open it. Otherwise, you can still open it. We will bring down the balance originally, whatever it was, maybe 200 million. Write off 93, you credit it, we shall carry down the difference. Okay? Good. You have understood. So another person called Jenny says, we repeat the one of investment here. We are told the investment was sold at the prevailing market price. Originally, it had a book value of 88 in the balance sheet. In the same balance sheet, somewhere in bracket, we were given some information concerning the market value. If I project the balance sheet, I hope you can see it here. We are given the market value of the investment here at 224. Okay? I'm talking to Catherine now. No. Shiro. Okay? That being the market value 224, and now the book value is this 88. So I've just opened this account called investment, brought down the balance by 88, sold the investment. We must have received the 224. I must have debited bank, which I did here. Here, I debited this investment bank account by 224. I had to credit this account called investment by 224. Then I said, now that you have sold the investment, you don't leave the account pending. You no longer have another asset called investment. You have sold it. So the difference in this account must either be a gain or loss on sale. And in this case, we are selling the investment at a higher value more than the book value. Therefore, we are selling it at a gain of 136. And I've told you, if we were running a normal business, I would have debited this investment by that 136. I would have credited P&L. It's a gain on disposal. But now we are not running a normal business. And we said any gain made in the process of reconstruction company should be credited in the capital reduction. That's why we are debiting the investment by 136 and crediting capital reduction by 136. Are you okay now, Shiro? Oh, you have already said yes. Ama, you wanted to say something else? Are you okay? Maybe we can now confirm. Ah, well, understood. Good. So we now move on. Thank you. We now move on. We go to the next note. If you think we are through with note 2. It's not number 2. We are through with number 2. Number 3 says, let's go to number 3. Number 3 says, the directors were to accept settlement. I'm reading note 3 now. The directors were to accept settlement of their loan as to 90% thereof by allotment of ordinary shares at par and 5% in cash, and the balance to be waived. Let me explain. If you look at the balance sheet, among the current liabilities, that's where we had directors' loans, we owed them how much? From the balance sheet, we owed them 160. When we were calling the stakeholders, they were one of them. We asked them, what can you do for us? Now we read note 3 again. The directors were to accept settlement of their loan as to 90% thereof by allotment of shares at par, and as to 5% in cash, and the balance was to be 5% was to be waived. Let me explain. We owe them how much? 160. Good. Listen, I've just told you a short while ago, when you are reconstructing the company through internal reconstruction, stakeholders are normally called into a meeting. One of the stakeholders who came are the directors. It's true, we acknowledge we owe them 160. We told them, what can you do for us? And they told us 3 things. They are willing to waiver 5% of the amount, provided 90% of the amount is paid to them through allotment of shares and 5% in cash. If we can meet those two conditions, then they are willing to write off the balance or to waiver the other 5%. So as a company, let's meet the two conditions. Then they waiver the 5%. We owed them 160. We asked them, what can you do for us? They gave us two conditions. For them to waiver 5%, they said, pay us 90% by allotment of shares, that means by shares, pay 5% in cash, and then we shall waiver the other 5%. Good. So let's open an account called Directors Loans. Let's open an account called Directors Loans. Make it about 4 lines. Bring down that liability that we owe to them, 160. We then meet the two conditions, then they waiver the 5%. Wamesema 90% to be paid by allotment of shares. So it means we pay a part of this 160, 90% of it, let's pay it by in terms of cash shares. So it's obvious we shall debit the directors' loans and credit ordinary share capital. We are issuing shares as a payment to the directors' loans. So maybe if you forget, we are getting it how? It is 90% of 160. That's what we are agreeing with them. We agreed with them, if we can pay them 90% of 160, then they can waiver 5% and we pay them the other 5% in cash. So that looks like 144. So 144 will be paid in terms of shares. Okay, good. So maybe what you can do below that, open the account called share capital because it's also being affected again. Open the account called ordinary share capital. Ordinary share capital. It was being affected again. Make it about 5 lines. Somewhere we were told to reduce the share capital. Now we can see we are allotting share capital as a payment. Good. But first bring down the original balance. Let's go to the balance sheet and pick up the original balance of the share capital. So if you look at the balance sheet among the finance by section, we are given 120 million ordinary shares of 10 each, amounting to 1,200 million. So bring down that 1,200. Good. We want to allot shares as part of the payment of the directors' loans. I've already debited directors' loans. Let us credit share capital and we come and say directors' loans. 144. We are issuing shares as a payment to the directors' loans. Then the condition is not still yet over. They told us, and 5% in cash. So let's give them 5% of the loan in cash, which is how much? 5% of 160 is about 8 million. Let me confirm. Yes, it's 8 million. So let us debit our directors' loans by 8 million. We debit directors' loans and we credit bank. Cash and bank, I told you, is synonymous. I said again, if you think you'll forget, just take it as 5% of 160. So we are paying 5% in cash. So 5% of 160, that is 8 million. I've already debited directors' loans. Let us go and credit bank. We'll go to where we opened a bank account and we credit it. And we come and say your directors' loans. We are paying them 8 million in cash. Good. That is it for that. Now we can waiver the 5%. I think as a company we have met the two conditions. We owed them 160. They said they are willing to help us, provided we pay part of that 90 in terms of shares and we pay the 5% in cash, which we have already made, and therefore they can waiver the balance. I hope you are through with the bank account. I want to roll now to the director's loans account here. So let us waiver the balance, which is how much? The other 5%, which automatically will become 8 million. Are you there? It's a gain again. Listen, we are writing off, or they are waivering 8 million, which is a 5% we are discussing. 5% of 160 is another 8 million. This is a gain to the company. We are reducing what we owe the directors, and therefore we are gaining as a company. So you come and say here, capital reduction. Good. So, which is, you can again say here, 5% of 160. That's how much they are wavering. Being a gain to us, we are debiting directors' loans and crediting capital reduction. So let's go to where we opened the account called capital reduction, and we credit it here. It's here. And we say directors' loans. The amount is 8 million. Good. So finish. We go to the next note. We want to find out what else are they telling us to do. So finish. Okay, so I want to go back to the question, see whether we are through with note number 3. So let me project it. Yeah, I think we are through with number 3. We go to number 4. Number 4, they are saying, I'm reading number 4, trade payables to be paid 0.1 shilling in every shilling to maintain and to obtain an extension of the credit period and to obtain an extension of the credit period. Let me explain. Don't forget, we are reconstructing this company through internal reconstruction. All the stakeholders have come. We have asked the creditors, those are the trade payables, what can you do for them, for us? Listen, they are saying, pay us 0.1 shilling for every shilling, and then we shall extend the credit period. They are not saying they are cancelling the balance. Don't forget. They are not saying, like the directors, that they are wavering 5%. They are not saying, the trade payables are not saying they are wavering the balance. They are saying, pay us 0.1 per shilling, for every shilling, and we shall extend the credit period. So, listen. So we still owe them the balance. Don't forget. It's only that if they normally collect debts, maybe after 90 days, when they sell the creditors, or maybe they collect after 30 days, they are now saying, we shall extend that period and allow you to pay us after 60 or 90 days. Maybe it was due in 30 days, but now we are saying, we don't have money, please help us. We called the creditors and we told them, we don't have money to pay you now. We are reconstructing this company, but we don't have money. So what can you do for us? They say, pay us 0.1 shilling. That means 10%. Pay us 10% and we shall extend the credit period. So if you go to the balance sheet, how much do we owe them? Among the current liabilities called trade payables, how much? If you look at the current liabilities there, the trade payables are given as 400 million. 400 million. So let's pay them 10% so that they can extend the credit period. I'm not saying they are cancelling the balance They are just extending the credit period. So we still owe them the other balance, the other 90%. So it's not something we shall write off like the director's loans. No. Good. So let us just pay them. We debit creditors. No, we debit, creditors. We debit creditors and we credit bank. So come to the bank account and you just say your creditors. Let's just call them trade payables. Trade payables. 10% of 400 million is 40 million. I don't need to open the trade payables account. Listen, I don't need to open the account called trade payables because it is again affected only once. When we shall be doing the balance sheet, you will remind me that we have reduced our creditors by 40 million. It was 400. We have reduced it by 40. So we still owe them 360 million. That is what will go to the balance sheet. Okay? So I don't need to open the accounts called trade. Of course you can open if you want, but it doesn't affect much of your marks. Good. So we leave it there. I've said we are not cancelling the other 360. Listen. So the benefit we have is a non-monetary benefit. It's not like the directors who waived 5%. That was a monetary gain. But these guys are only extending the credit period. So we are still gaining, yes, but not in terms of monetary gain. It's just a support they have given us to pay them later, not immediately. Maybe the creditors were already due. Good. Fine. Are we okay to move on now? I think we are okay. So with that note, number 4, I think we are through about the period being extended by us paying 10% or 0.1 for every shilling. Good. So let's go to the note number 5. I think we are through with number 4. So that's all for number 4. They were saying trade payables are to be paid 0.1 in every shilling to maintain and obtain an extension of the credit period. Good. Number 5. Number 5. It says, I'm reading it, the bank has sanctioned an overdraft limit of 10 million to provide working capital. The bank has sanctioned an overdraft limit of 10 million to provide for working capital. Question to you is this: debit which account, credit which account? Tell me very fast. I want to see or to hear. We have called, listen to that, listen to the case. Don't forget, we are reconstructing this company internally. Another group of stakeholder is the bank. We owe them some money. Now they are saying the bank itself is a stakeholder in our company. The bank has agreed to sanction an overdraft limit of 10 million to provide working capital. So what account do you think we should debit? Which account do you think we should credit? The bank has sanctioned an overdraft limit of 10 million to provide working capital. Which account do you think we shall debit? Which account do you think we shall credit? Catherine says we debit bank and credit capital reduction. They have sanctioned an overdraft limit of 10 million. They have sanctioned an overdraft limit. They are not. I wanted to give you the answer. I was almost saying the answer. Somebody else is saying with debit capital reduction, credit bank. Now listen. listen to something else so that we move faster because of time. Now, has the bank given us the 10 million? Yes or no? Let me hear. Has the bank given us the 10 million? Yes or no? Read that statement and tell me. Has the bank given us the 10 million? Yes or no? Catherine says not yet. Chelsea says no. Good. Now listen. Correct. The bank has not yet. Listen. The bank has not yet given us the 10 million. But what they are saying is this. In case you as a company, you need some more money to facilitate buying working capital items like stock, we can allow you to write a check of up to 10 million and it will be honored. That's exactly what they are saying in simple. They are saying we can allow you anytime you want to overdraw from your bank account, we can allow you to overdraw up to a limit of 10 million. Have we withdrawn the money? Have we drawn the money? Not yet. Listen, not yet. Can I withdraw anytime I want? Yes. I can write a check of 10 million and the bank will honor it. So listen carefully. So that note was there to confuse you as a student. Reason being, remember, we have not received the 10 million yet. Or in other words, we have not utilized that facility yet. The bank has just sanctioned an overdraft limit of 10 million. Meaning, as a company, we are allowed to withdraw up to 10 million. Have we withdrawn? Not yet. So is there any transaction that has taken place for 10 million? No. So what the examiner was tricking to see is whether you have realized that there was no transaction. They are only giving us a facility yet to be utilized. We have a facility of withdrawing up to 10 million, but we have not utilized that facility yet. Are we there? So it is obvious, therefore, listen, it is obvious, therefore, the examiner did not expect you to record any transaction on that 10 million. Because no transaction has taken place. We have not been given the 10 million. But anytime you want to use the facility, the overdraft facility, the bank has allowed you to an extent of up to 10 million. So that is the only benefit we have from them now. Again, this is an unmonetary gain as it is now. We have no monetary gain here. We have an unmonetary gain. That they are willing to sanction an overdraft up to a limit of 10 million. But we have not been told that the company has utilized that facility yet. It's only that we are told the bank has sanctioned an overdraft limit of 10 million to provide for working capital. So for that transaction, for that item number 4, number 6 or 5, whatever, the examiner did not expect you to record any transaction. Why? Because we have not paid, we have not withdrawn the facility. If the question had told us we had written a check of 10 million and it was honored, then it would have recorded that transaction. But now, as the question stands, yes, as a company, we have the ability to overdraw our bank account by up to a maximum of 10 million. Have we withdrawn? Not yet. Okay? I hope that's clear. That it was a note that was there to trick you. We record no transaction for it. We record no transaction for it. Why? Because we have only utilized the facility. We have not utilized the facility yet. It's only that we have been given that ability to overdraw. Have we overdrawn? Not yet. So we cannot record something that has not taken place. There is no transaction. We have only been given an ability to withdraw up to a maximum of 10 million. Can we move on? I think yes. Can we move on? That there is no transaction there. We only have a non-monetary benefit as at now. Okay? Good. I think I can move on now. So let me go to the next transaction now, or to the next item. So we are through with number 5. Is it number 5 or 6? Yes, number 5. Number 6 says, I'm reading number 6 now. Preference dividends, the 6% preference dividends are 4 years in arrears, of which 3/4 are to be waived, and ordinary shares are to be allotted for the balance. Okay, they are saying, let me be there. Preference dividends are 4 years in arrears, of which 3/4 are to be waived, and ordinary shares are to be allotted at par for the balance. So if we look at the balance sheet, there is no preference dividends that are in arrears there. If you look at the balance sheet among the liabilities, we don't have preference dividends in arrears. Yet we have not paid them for the last how many years? 4 years. So we owe them. But now the point is this. The question is saying, whichever the amount we owe them, these guys are willing to waiver 3/4 of the amount, and ordinary shares to be allotted at par for the balance. There are several things to be done there. Let me explain. 1, get the amount of the arrears. 2, know that this is an example of a contingent liability. I don't want to ask you the double entry here because of time, but the question wants you to realize, 1, first you will calculate the amount of the arrears. 2, you realize this is a liability that as a company owe their shareholders, but it doesn't appear in the books. So every time you have such a liability, it must be crystallized. So it's an example of a contingent liability. Once you crystallize it, whatever the amount we shall get, the question has told us, these preference shareholders are willing to waiver 3/4 of the amount, provided the balance of the preference dividend is paid to them by allotment of shares at par. Okay? So let's first compute the amount of the arrears. Then we needed to realize it's a contingent liability. If we had time, I would have not mentioned it. I would have also told you to tell me the double entry. Good. So let's do the calculation. Andika somewhere there. Preference dividends in arrears. Preference dividends in arrears. How much? We need to calculate. I go back to the balance sheet, see what's the rate of dividend. What's the nominal value of the shares? From the balance sheet, I can see these guys are earning 6%. The share capital is 640. Good. 6% of 640 is the dividend per annum. So 6% of 640, multiply that by 4 years. So in total, we owe our preference shareholders how much? If I'm correct, I'm getting an amount of 153.6 million. Or just call it 153, because already our figures are in millions. Yes, 153 point. Chelsea, is it 1,500 and I'm a 153 point? Because me, I'm getting point. Wow, the point. I'm the one who is wrong. Oh, 0.3, 0.6. Good. Now, good. So let's now crystallize it. let's make it as a liability in the books. It was not there in the books. Make it as a liability. So open this account we were calling preference dividends in arrears. Now that you know the name of your contingent liability, open the account by the name. I told you that. So we want to crystallize this liability. How do we crystallize it? We said you debit capital reduction. Let us debit capital reduction. So let's go to where we opened this account called capital reduction. Where is it? It's here. We debit capital reduction and we credit preference dividends in arrears. Preference dividends in arrears. 153.6. I've debited capital reduction. By 153.6, let us credit the preference dividends in arrears, and we say a capital reduction 153.6. Good. Then they have told us the guys are willing to write off or to waiver 3/4 of this amount and the balance to be allotted in terms of shares, meaning you give shares as a payment of the balance of the other quarter. Good. So let us waiver the 3/4 of this amount. Of course, it's a gain to the company. We are writing off 3/4 of this amount. So we debit contingent liability and we credit capital reduction. How much is 3/4 of 153.6? What is a quarter or 3/4 of that? If I'm correct, I'm getting 115. Good. Somebody has already confirmed 115.2. I have debited preference dividends in arrears. Let us go and credit capital reduction. It's a gain to us. And we said any gain the company makes should be credited in the capital reduction. So you come and say a preference dividends 115.2. Having recorded the gain, now we can pay the balance of the other quarter in shares. So let's now pay them because they gave us that condition. So let's go to the arrears account and we come and say ordinary share capital. Ordinary share capital. We can say a quarter of 153.6. How much is that? Looks like that. Good. Somebody has already given me 38.4. Good. So having debited preference dividends in arrears by 38.4, let's credit share capital. We had opened the share capital before because I said it was being affected again. Where is it? It's here. So come and say our preference dividends. It is 38.4. So go to the share capital account and you credit 38.4. So I think we are through with that. We called in the preference shareholders in a group of our meeting and we asked them what can they do for us. And they said they are willing to write off 3/4 of the preference dividends so long as we pay them the other quarter in shares. So there are several things the examiner wanted you to realize there. First, compute the amount of the arrears. And remembering that it's not in the books, you have to crystallize that liability, which we have done. Once you crystallize that liability, you have also to remember, being a contingent liability, we debit capital reduction, credit preference dividends in arrears was coming to 153.6. They were willing to write off 3/4. So once you crystallize, We debit the capital, we debit preference dividends in arrears by the 3/4 of the amount, which was coming to 115.2. We credited capital reduction. It's a gain to us. Once we did that, now we can meet their condition by paying the balance in terms of shares. We have given them shares worth amounting to 38.4. Have debited preference dividends in arrears. It's a liability as a payment. I have credited ordinary share capital. Good. I think we can now move on to the next item. I think we are through with almost all the additional information now. Let's confirm. Oh no, we are remaining with 2. We are through with number 6, so let's do number 7 and 8. Let's do number 7 and 8. Number 7 says, I'm reading number 7 if you are there. Preference shares are to be written down to 7.5 and existing ordinary shares to 2.5. 2 shillings each. All ordinary shares are to be consolidated into shares of preference dividend, whatever. But let us first write off the preference. Preference shares are to be written down to, not by. Preference shares are to be written down to. Some questions may tell you written down by. This one says to. Good. So we go back to the balance sheet, see what is the par value per share for preference. If you look at the balance sheet, we were given one share had a par value of 10. We are told to write them down to 7.5. Is it 7.5? Yes. So it means one share is losing 2.5. 2.5 per share is what we are writing off. How many shares are there? If you look at the balance sheet, there are 64 million shares. So in total, we are writing off 64 million times 2.5 of the preference. So I debit preference share capital, I credit capital reduction with amount written off on share capital. Where was that capital reduction? Here. So come and credit preference share capital. You say your preference share capital. It is 2.5 times 64. 2.5 times 64, that's what we are writing off. That's 160. So we debit preference share capital and we credit capital reduction. Listen, I don't need to open the account called preference share capital because I don't think it has been affected again. It's not like ordinary. I did not read anywhere else where the examiner told us to affect the preference. So I don't need to open it. Otherwise, even if I open it, it's just a one transaction. So you will remind me when we are doing the balance sheet that our preference share capital should be reduced by 160. So we are saying, or we were told, preference shares to be reduced to 7.5 each. So originally the par value was 10. If we are reducing them to 7.5, it means we are writing off 2.5. Then we have to check how many shares we had, 64 million. So we total are writing off 160 million. We know with the amount written off on share capital, you debit share capital and you credit capital reduction. The same note goes on to say, the same note number 7, and ordinary shares to, that's what note number 7 is saying, and ordinary shares to 2 shillings each. We do the same, go back to the balance sheet, see how many shares are, what was the par value? 10. Okay, how many shares did we have? For ordinary, 120. We are told to reduce them to 2 shillings. So if the par value per share was 10 and I'm writing them to 10 shillings, it means I'm reducing them by 8. 8 on 120 million is what we are writing off on ordinary. Good. So let us write off how much? 8 shillings per share times the 120 million. I think it's 120 million. Yes, 120 million on 8. Good. Of course, you know the double entry. We have discussed this. With the amount written off on share capital, you debit share capital and you credit capital reduction. I think I'd opened the ordinary shares capital before. Where is it? We had opened an account called ordinary. Good, here. So let us write off and we come and see a capital reduction. Put in bracket 120 times 8. We are reducing them by 8 because we were told to reduce them to 2 shillings. So that looks like 960 if I'm correct. 12 times 8, that's 96. That looks like 960. I have to debit share capital. I credit capital reduction. So let's go to where we opened the account called capital reduction. Here it is. And we credit and we say ordinary share capital. That is 960. Good. I think that's all for that. So we are just writing off the share capital. Maybe if you again forget, you can put there 120 times 8. Just to remind you, we are writing off 960 and we are getting it by taking 120 times 8. Good. Next, I think we are almost through. What's the next transaction? Okay, let me explain the balance. The remaining of number 7. They are saying all the shares are to be consolidated into shares of 10 each. The rate of dividends is to be increased to 10%. Now, listen, those 2 other items, they have no effect on the entries. Let me just explain. After writing off 8 shillings per share, listen, the company decided to consolidate the remaining shares into shares of 10 each. Listen, let me just explain in simple so that you understand. Assuming your company had 10 million shares of shillings 10 each, that gives you 100 million. Listen carefully. If you reduced the shares to 2 shillings, it will remain 10 million times 2. That comes to 20 million. Listen. So this is the position after writing off the 8 shillings. Then the examiner is saying, and the shares to be consolidated to shares of 10 each. Listen. Whenever you consolidate shares, the capital of the company doesn't change. So it will still remain 20 million after consolidation. What they are only changing is now one share is no longer of 2 shillings. It should be of 10. Listen. So when you are consolidating the shares, what you are only changing is the number of shares. You are not changing the capital value of the capital. You're not changing the capital amount. So if the remaining were consolidated into shares of 10, I've said our capital will still remain here 120 million. Now the par value is no longer 2 shillings, it's 10 shillings. But how many shares do we need? For us to get shares worth 20 million, worth of 10 each, then you need only 2 million shares. So we are consolidating shares of 10 million originally and making them 2 million shares. There were 10 million shares of 2 each after the write-off. But immediately we were told to consolidate them into shares of 10 each. So I've said, whatever the capital that is there after write-off, that capital does not change. It still remains, like in this illustration, 10 million. What changes is the number of shares. So that means by changing the number of shares in a company, that does not affect the double entry in the books. Because that's not a capital amount. It's not an amount. It's just the number of shares. So what is more important, if the capital was affected like originally it was, we had to write off the 960. But how to consolidate the remaining shares, that was just there to confuse you as a student. That was there to confuse you, so that you reduce again. While we are not reducing the amount of capital, we are reducing the number of shares from 10 million to 2 million, whatever it is. Okay, so we are only consolidating the number of shares. We are not consolidating their capital amount. No. Good. Then the same note goes on to say, and preference share dividend to be increased by 10%. Again, listen, it has no effect on the double entry. We just called the stakeholders called preference shareholders. You remember they wrote off part of their preference dividends. Now we are promising them from now onwards, your dividend will be increased to 10% from now onwards. But it is not something that affects the books now. No. We shall only be paying you now in the future at 10%. Maybe, yeah, because you remember the rate was 6%. But now we agreed we shall be paying you at 10%. That is just their non-monetary item. It doesn't affect monetary item, so you don't record it. Are we there? So the last two items was there to confuse you so that you record a transaction, yet there is nothing to record. When shares are consolidated, you only change the number of shares. You don't change the capital amount. Capital remains the same. They are only consolidating. Like here, we are moving from 10 million to 2 million. It means you are taking 5 shares. It means you are taking 5 shares originally and consolidating them and making it 1. Because if we are making shares of 10 to be 2 million, since you are consolidating in the ratio of 1 to 5. Okay? Good. Otherwise, the last two items were not affecting the recording of the transaction. When you consolidate shares, you're only changing the number of shares. 2, we have told the preference shareholders, you are currently earning at 6%. From now onwards, we shall increase your dividend rate to 10%. That is just something you are promising them, but it doesn't affect the books now. I hope you have understood that. Good. I think we can go to the last item now. We can now go to the last item. So that was number 7. That number 7 was about reducing the share capital. We have done. For preference, we reduced. For ordinary, we have reduced. But then the consolidation is the one I'm saying that does not affect the books. The other one is increasing the rate of dividend. That does not affect the books. No. Good. So next, number 8. Number 8 says there was a capital commitment amounting to 600 million which are to be cancelled by a payment of 3 1/3% of the contract price as a penalty. Let me explain because of time again. Otherwise, I should have given you a challenge. Listen, we have a capital commitment. We have not spent the amount of 600 million. We have just called a contractor, for example, and agreed with them they will construct a building for us for 600 million in the future. They will construct a building or build a road for 600 million. So as a company, we have committed ourselves to spend that 600 million in the future. We have even signed an agreement. But because we have been suffering for long, now we feel, let us cancel that contract. But there is a clause in the contract that says, in case you cancel, there is a 3 1/3% penalty to cancel the contract. So we have not spent the 600 million. I hope you are getting. It's just a capital commitment that we have gone into. But we feel we cannot sustain that capital commitment. Let's cancel it. The penalty is 3 1/3% of the contract price as a penalty. So we are only paying the penalty. We are not recording the 600 million. Hope you are getting. Because 600 million is not an amount we have spent. It's just a capital commitment. Either to build another building or to build a factory in the future or maybe a road, whichever it is that they agreed. We don't know. But they have just gone into a capital commitment to spend 600 million in the future. Have they spent? Not yet. But they feel they have to cancel that agreement. but it will cost them 3.3%. Let me take 3.3% of the 600 million as the penalty. We pay it and then we cancel the contract. Okay, good. So what is 3.3%? Of 600 million. That looks like exactly 20 million. 20 million is the penalty we are paying. The contract was 600 million. We are told we spent or we pay a penalty of 3.3% of the contract price as a penalty. Listen, it's obvious this is a loss to the company. I hope you are getting. This is a loss to the company. And I told you, now that we are not running a normal business, we debit capital reduction. Otherwise, if it was a normal business, I would have debited an account as an expense for that penalty. But now we are not running a normal business. We are reconstructing the company. So let's go debit capital reduction and we credit bank with that 20 million as a penalty. With that 20 million as a penalty. Where is the capital reduction? Here. So I'm debiting capital reduction. We come and say a bank, put in bracket penalty. Just to remind you, we are paying for the penalty. And the amount was, to my honor, 20 million. 3.3% of 600 million. Good. So let us debit that and we credit bank. Let's go to the bank account and we credit 20 million. Where is the bank account? It's here. And we come and say here capital reduction. Put in bracket penalty. 20 million. 20 million. Okay. Listen, before I close, maybe we shall finish the question later. We can't finish it now. But before we leave it, listen carefully. Listen carefully. Before we leave the question to be completed later. What we have just done so far is to try and implement the scheme that the examiner gave us. Listen. But I hope you still remember that there is one more thing to be done. What is it before we close the books now? It's like we are through. But before we close the books, what do you think we should do? Before we balance these accounts and prepare the balance sheet, what do you think we shall do? Somebody? What do you think is remaining? What do you think is remaining? I told you one thing and I hope you still remember it. I told you one thing and I hope you still remember it. What was it? Oh my, it seems some people are good. No, not yet. Before we balance the accounts, what else have we not done? There is one thing we ought to do before we balance their capital reduction to get our reserve, blah, 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 blah. That's not what I'm looking for. There is something I told you. Good. Thank you, Anita. Yes, Anita, you have remembered it. And that is what I said. Some questions don't remind you to write off the accumulated losses. Remember, it was one of the transactions that must be undertaken in a reconstruction scheme. The reason why we are reconstructing this company is to help the company to eliminate the accumulated losses from their books. We help them also to start their activities in a more attractive and profitable manner. So this question, we have gone from note number 1 to number 8, and there is nowhere they are reminding us to write off the accumulated losses. Sorry. Yet, that is the aim of the topic. Why are we reconstructing this company? To help this company to eliminate the accumulated losses. So Anita, you have remembered, thank you. So it means before we close the books, let's write off the accumulated losses. So you go to the balance sheet, check how much were the retained losses. You can see from this balance sheet, we have accumulated losses amounting to 656 million. 656 million. They have to be written off. They have to be written off. Good. So in that case, remember to write off. Losses I've told you are a debit balance. Therefore, to write them off, you credit P&L account, and I told you, you debit capital reduction. So come to the P&L capital reduction, and you say your P&L account, or you can even call it accumulated losses so that you remember. Accumulated losses. 656 million. That is something you should not have forgotten. Write off the accumulated losses. Good. So I think now we can stop there. Next time we shall balance these accounts, then extract a balance sheet from them, because we have gone too much. We do not have time to finish it. So maybe for today we can stop there. We pick it up from there next time. We pick it up from there next time. So let's stop there for now. We pick it up from there next time. Now, before we finish, or before we close for the today's class, listen. Before we close for today's class, some of you are joining our class. Listen. Some of you have joined our classes and you wish to continue with us for normal online class, or maybe you have friends who have not joined our online classes. Listen. So tell your friends who would want to join that we have online classes for advanced financial reporting of the advanced level. Tell them we have online classes for advanced financial reporting of the advanced level. Tell them we have also online classes for financial reporting of the intermediate level. Tell them we have also online classes for financial management of the intermediate level, and the one of financial accounting of foundation level, and the one of ATD1 and ATD2. They also have financial accounting. So as at now, those are the 4 subjects we are offering our online classes for. So you can join us for those online classes, or if you have friends who have not joined, tell them they can join us. Advanced financial reporting of the intermediate, financial management, and financial accounting. For whatever reason, if they cannot be able to join the online classes, then tell them that they can buy what we call the pre-recorded videos, whereby they can watch the videos at their own free time, at their own pace, and whenever they have a question, they can call me anytime. So if they are not able to join the online class, maybe they are going to miss a few, or whatever reason, then they can buy the pre-recorded videos. For cost, you can reach me on this number, 0722 658875. For more details, get me on this number. You can write or chat or call me on this number, 0722 6588. This is 8875. So take that number, call me anytime for more information about the cost. For those who need the country code, it's 254-722-658875. Good. Now listen again. Listen again. So those are the 4 subjects we are currently offering online course. Now some of you are watching through YouTube. Some of you are watching through YouTube, and maybe you have not subscribed to to my YouTube channel. Some of you are watching through YouTube and maybe you have not subscribed. Please click that subscription button down there so that you can subscribe to my YouTube channel. Of course, the name of the YouTube channel is called CPA Joseph Juguna. That's the name of the YouTube channel. That's where we normally post some videos for promotion. There are some which are also there. You can go and watch them. And if you have not subscribed, please subscribe to my YouTube channel by clicking that subscription button. Okay. Again, for those who are watching through YouTube, click that like button to like the video. I hope you have understood something today. So click that like button. You can even put a comment. I'll read it. Otherwise, maybe we can stop there unless there is a concern, any other question. I hope we have understood something today. Somebody to put a comment down, chat and tell me yes. I hope you have understood something today. Put a comment for those who are watching through Zoom. I want to see. That one I'll see. For those who are watching through Zoom, I hope you have understood something today. Yes, Grace says yes. Good. Grace says yes. So maybe we are good. Yes, Catherine says I have. So thank you. See you. But tell your friends that we have those online classes for the 4 subjects. One for the advanced financial reporting, which we are doing now. Financial reporting of the intermediate, financial management, and financial accounting. So maybe we can stop there. We pick it up from there next time, where we shall finish the question, balance the accounts, then extract a balance sheet. Extract a balance sheet from there. Otherwise, see you next time. Bye for now. See you next time. Bye for now. So call me on that number for those who have not joined. We discuss the cost. We also accept payments on installments. No problem. Bye for now. Yes. See you.